They've been buying it quietly, month after month. Not stocks, not bonds, not oil, gold. For 18 consecutive months, China has added to its official gold reserves, even as prices hovered near all-time highs. In April 2024 alone, the People's Bank of China acquired another 60,000 ounces. By public records, their total now exceeds 2,300 metric tons. But off record, Western analysts suspect the real number could be double, hidden through sovereign wealth funds, state-owned banks, or off-balance sheet structures. Not for profit, not for safety, for something far more strategic. Because gold isn't just a hedge. It's not an old-world relic. It's the only monetary asset with no counterparty risk, no signature from Washington, no liability from Brussels, no algorithm in New York. It cannot be frozen. It cannot be inflated away, and it does not need permission to hold value. Since the 2008 crisis, no nation on earth has bought more gold than China, not even Russia. And unlike speculative investors, Beijing isn't buying to sell later. They're accumulating to replace. This isn't diversification, it's preparation. Gold has become China's quiet weapon in a financial war most people don't even know has started. Because while headlines focus on trade disputes, Taiwan tensions, and chip embargoes, the real decoupling is happening beneath the monetary surface. And when empires lose control, it's rarely through firepower. It's when their currency stops commanding obedience. So if China is arming itself with gold, what battle are they really preparing for? Since November 2022, China has been on an unbroken gold buying spree. Every month. No pauses, no reversals. It began with modest additions, just tens of thousands of ounces. But by mid-2025, the pattern was unmistakable. This wasn't hedging, it was repositioning. Officially, the People's Bank of China holds just over 2,300 metric tons of gold. But that's only the surface layer, because not all acquisitions show up on the central bank's balance sheet. Behind the curtain, entities like SAFE, the State Administration of Foreign Exchange, along with sovereign wealth funds and state-affiliated banks have been accumulating far more, quietly, deliberately, and always off the radar. Simultaneously, China has been reducing its exposure to U.S. Treasuries. At its peak in 2010, Beijing held over $1.3 trillion in U.S. debt. Today, it's under $800 billion, and falling. This isn't portfolio balancing. This is systemic disengagement. The message is clear. China isn't just buying gold. It's withdrawing trust from the dollar-based financial order. Every ounce acquired is a vote of no confidence, not in markets, but in the architecture of Western control. Gold is not just a commodity here. It's the monetary equivalent of desertion. Analysts like Zoltan Pozsar have been warning for years. This is the slow-motion exit from Bretton Woods to Bretton Woods, the United States redeemed too. And China isn't alone, but it is leading. They're not diversifying, they're defecting. But what if the numbers we're seeing aren't the whole story? Officially, China holds just over 2,300 metric tons of gold. That's the number reported to the IMF. It's what shows up in World Gold Council charts, and it's what Beijing allows the world to see. But few serious analysts believe that number. Unofficial estimates place China's true gold reserves somewhere between 4,000 and 6,000 metric tons. Reports from HSBC, Bloomberg Intelligence, and Swiss Re point to a significant discrepancy between declared holdings and actual flows. Where does the rest go? The answer lies in opacity by design. Unlike Western central banks, China is not bound to report reserve changes in real time. There's no legal or treaty obligation forcing transparency, and China uses that gap strategically. Gold can be accumulated through state-backed banks. It can be imported quietly through Hong Kong, through the UAE, or directly from Russia without passing through official disclosure channels. It can also be held off-balance sheet by agencies like SAFE, or categorized under other assets in shadow portfolios. This isn't new. The Soviet Union used similar tactics during the Cold War, stockpiling gold silently while projecting economic weakness publicly. In a monetary system built on narrative control, the less your rivals know, the more control you retain. What the world sees is a gold iceberg, just the tip. Below the surface lies a vault of strategic intent. If they're hiding gold, what else are they hiding? But the how much is only part of the story. The why cuts deeper. Gold does not clear through SWIFT. It doesn't sit in Western banks. It doesn't carry counterparty risk. And that's precisely the point. When the US froze over 300 billion of Russia's foreign reserves in 2022, it sent a message, louder than any sanction, that the dollar, once the world's neutral reserve, had become weaponized, a tool of political enforcement, not just economic utility. China heard that message. Gold cannot be frozen. It cannot be digitally blocked or unilaterally canceled. It is not issued by any central bank. It has no CEO. And it doesn't answer to Washington. This is not about return on investment. It's about insulation, protection, redundancy. Gold is what China uses to settle oil purchases from Iran, outside SWIFT. It's what flows silently between state entities, unregistered in dollar-denominated systems. It's how China can hold real value without trusting any other country's promise. Unlike bonds, gold doesn't promise anything. It just exists. For China, this isn't about killing the dollar. It's about preparing for a world after the dollar stops ruling uncontested. A post-dollar world, not an anti-dollar world. And that's why China is stacking gold, not to gamble, but to fortify. What if gold isn't a bet, but a bunker? And China is not alone in digging in. The dollar isn't collapsing. It's being walked away from, step by step, deal by deal, decade by decade. In 1999, over 70% of global foreign exchange reserves were held in US dollars. By 2024, that number has fallen below 58%. This isn't a flash crash. It's erosion. Russia saw it early. After the annexation of Crimea in 2014, Moscow realized it couldn't afford to rely on a currency its adversaries could freeze. The central bank began dumping treasuries and hoarding gold, building walls no sanction could breach. India followed a different path. Rather than hoarding, it diversified, building reserves in gold while pushing for trade settlements in rupees, quietly turning a domestic currency into a diplomatic tool. Brazil rebalanced its basket, reducing exposure to the dollar, increasing allocations to the euro and yuan. A signal, not just of diversification, but of shifting trust. In Southeast Asia and the Gulf, similar moves emerged. Malaysia, Turkey, Saudi Arabia all started adjusting reserve strategies, many for the first time in decades. This is not a revolt, it's a reconfiguration. It's not just about what countries are buying, but what they're no longer buying. Treasury bonds, dollar debts, American promises. The dollar isn't being dethroned, it's being deprioritized. And while headlines focus on Beijing, this isn't a China story. It's a map-wide migration. The architecture of trust is being rebuilt brick by brick, outside the reach of Washington. What if the alternative system is already here, just decentralized, and within that system, China is quietly building the keystone, the petroyuan? Since 2023, China has been buying oil from Russia and Iran, not in dollars, but in renminbi. It started quietly. Then, in December, Saudi Arabia signed energy cooperation deals that included RMB settlements. For a kingdom that has anchored the petrodollar since the 1970s, this was not just a trade shift, it was a signal. But the RMB is not a global reserve currency. It lacks the scale, trust, and convertibility of the dollar. That's where gold enters. China isn't just paying in yuan. It's building a mechanism of trust behind it. Here's how it works. A Chinese importer pays for oil in RMB. The oil exporter, say Iran or Russia, then converts that RMB into gold through the Shanghai Gold Exchange. No SWIFT, no Fed, no visibility from Western financial systems. Gold becomes the bridge, RMB moves the oil, the dollar stays on the sidelines. This isn't about replacing the petrodollar, it's about routing around it with an entirely new track. Think of it as financial judo. China doesn't confront the US head-on, it steps aside and rewires the incentives. For energy sellers under sanctions or wary of Washington's reach, this setup offers not just an alternative, but insulation, and each transaction, though small, chips away at the dollar's network effect. Trust starts to migrate, not in headlines, but in quiet oil-backed conversions. They're not fighting the system, they're replacing its rails, and this slow rerouting is already leaving a mark on the dollar's status. The US dollar still dominates. As of 2024, nearly 88% of all international transactions involve it. No currency even comes close. But global dominance isn't about absolute usage, it's about relative leverage. And every time a country settles trade in RMB or stores reserves in gold, that leverage erodes. Because when fewer nations rely on the dollar, fewer nations are subject to its rules. The shift didn't start with China. It started when the US turned the dollar into a political weapon. Freezing Russian assets in 2022 wasn't just a sanction, it was a signal. Your reserves aren't yours if they're held in dollars. Trust fractured. Historically, the dollar's power was never legal. It was consensual. In 1944, at Bretton Woods, the world anchored itself to the dollar not out of fear, but faith. Faith that America, backed by gold, would provide stability. In 1971, that gold link was severed. The dollar floated, but faith remained. Now, each round of money printing, each debt ceiling crisis, each financial sanction chips away at that foundation. This is not collapse, it's recalibration. Gold doesn't replace the dollar, it limits how far the dollar can stretch. And as more nations hedge with hard assets and local currencies, the system becomes multipolar, not by design, but by necessity. The empire isn't burning, but its foundation is being dug from underneath. So what happens? When trust runs out before money does, China hasn't declared war on the dollar. It hasn't demanded a new system. It hasn't called for revolutions in global finance. It's just buying gold, quietly, relentlessly. No speeches, no threats, no ultimatums. Because real power doesn't need volume. It compounds in silence. Beijing isn't trying to collapse the old order. It's building the scaffolding of the next, brick by brick, bar by bar. And gold doesn't scream. It waits. For decades, the dollar reigned not because of force, but belief. That belief is no longer absolute. Gold doesn't challenge that belief directly. It does something more dangerous. It offers an alternative, an escape hatch, a system without signatures, without sanctions, without permission. If China can opt out, who's next? Saudi, Turkey, Brazil, maybe even the investors watching this, who now wonder what money actually means. The endgame isn't a crash, it's a quiet exit. And the real question isn't when the dollar falls, it's this. When belief in paper fades, what will you be holding?